If you are on Social Security and Medicare, you need to hear this before January. The projections for the 2027 cost of living adjustment are already out, and analysts are calling for an increase somewhere between 3.7 and 3.8%. That sounds like good news. For the average retiree collecting around $1,137 a month, that works out to roughly $73 more every month. $73. Some people hear that number and feel relieved. They start thinking about what they will do with that extra money. Maybe cover a higher electric bill, maybe put a little aside. But here is what almost nobody is telling you right now. Medicare is not waiting. The projected Part B premium for 2027 is already sitting at $250 a month, up from $290 this year. That is an automatic deduction that comes out of your Social Security check before it ever reaches your bank account. And that is just the beginning of what is about to happen to that raise you have not even received yet. Stay with this video to the end. Because what most people do not realize is that the COLA increase and the Medicare premium increase are only two pieces of a much larger picture. There are offsets, surcharges, thresholds, and rules that quietly chip away at that adjustment every single year. By the time you understand all of them, you will know exactly what to watch for, what to fight back against, and what programs exist right now that can put real money back in your pocket. The last item in this video is the one most Florida seniors never reach, and it is the one that could matter most. Before we go any further, if you are not subscribed to this channel, do it now. The rules around Social Security and Medicare change every single year. The government does not send you a letter when the thresholds shift. This channel tracks those changes so you do not have to. Now let me tell you about Dorothy. Dorothy is 74 years old. She lives in St. Petersburg, Florida. She is a widow, and her only income is Social Security. She gets $1,580 a month, which after years of modest COLAs feels tight but manageable. When she heard that the 2027 adjustment might be around 3.8%, she did the math in her head. She figured that was about $60 more a month. Not much, but something. She started thinking maybe she could afford to keep the air conditioning a degree or two cooler next summer. Then her neighbor, a retired accountant, sat down with her at her kitchen table and started explaining what actually happens to that money. By the time he was done talking, Dorothy was not excited anymore. She was asking why nobody had ever explained this to her before. That is a good question, and it is what this entire video is about. Here's why you have never gotten a clear explanation. There are two systems running in parallel. Social Security calculates your COLA each year based on inflation data from July, August, and September, using an index called the CPIW. Medicare calculates its Part B premium increase on an entirely separate track, using a formula based on projected healthcare spending, enrollment growth, and program costs. These two systems do not coordinate with each other to make sure you come out ahead. They do not share a goal of protecting your purchasing power. They run independently, and every year millions of retirees discover that the increase on one side is partially or fully eaten by the increase on the other side. Most financial advisors do not sit down with people in Dorothy's income range and walk through this interaction. The clients who get that conversation are the ones with substantial investment portfolios. Seniors living on Social Security alone are largely left to figure it out on their own, and the Social Security Administration does not proactively explain premium mechanics in the letters it sends. You get a notice telling you what your new benefit amount is after deductions. You do not get a breakdown of why the number is lower than you expected, so let us go through exactly what is happening and what you can do about it. The first thing you need to understand is how the COLA and the Part B premium interact for most beneficiaries. If you are already on Medicare and your Social Security benefit is large enough to cover your Part B premium, the premium is automatically deducted from your monthly check. You never see that money. It never hits your bank account. So when the 2027 projected COLA of around 3.8% adds roughly $73 to the average monthly benefit, and the Part B premium simultaneously increases from $290 to a projected $250, that is $6.60 per person per month going straight back out before you see a single dollar. For a couple where both spouses are on Medicare, that is over $13 a month gone immediately, or more than $158 for the year. The raise shrinks the moment it arrives. And most people do not realize this is happening because they only see the final net deposit in their account. They assume the raise was just smaller than expected. The reality is the raise was intercepted at the source. There is something called the hold harmless provision that protects most Social Security recipients from having their net benefit actually decrease when the Part B premium goes up. What it does not do is protect you from a raise that gets partially absorbed. The protection kicks in when the premium increase would cost you more than the COLA gain. In those years, your net benefit stays flat rather than going negative, but in a year like 2027, where the COLA is projected to outpace the premium increase, hold harmless does not protect you from the erosion. You get less than the headline number suggests. You get what is left after Medicare takes its share first. Here is what you do. When the official COLA announcement comes out in mid-October, do not just look at the percentage. Look at your current benefit amount, calculate what the new amount will be, and then subtract the new Part B premium. That net number is your actual raise. Write it down. Compare it to what you were getting before. That is the real increase hitting your bank account. If you want to know your exact current deduction, log in to ssa.gov and look at your benefit verification letter. It shows your gross benefit and the Medicare deduction separately. Knowing those two numbers is the starting point for everything else in this video. The second thing you need to understand is the Part D deductible increase that is already confirmed for 2027. This one is not a projection, it is locked in. The standard Medicare Part D prescription drug deductible increases from $650 in 2026 to $700 in 2027. That is an $85 increase in what you pay out of pocket before your drug coverage kicks in at the start of each year. For the average beneficiary who fills prescriptions regularly, January becomes an expensive month every single year because that deductible resets on January 1st. Most seniors absorb this cost without realizing it is directly connected to their benefit calculation. They see their COLA notice in October. They feel okay about the new number. Then in January, they start filling prescriptions and paying full price until they hit $700 and they feel the squeeze without connecting it back to the COLA that was supposed to help them. The annual out-of-pocket cap for Part D does increase in 2027 from $2,100 to $12,400. That is a benefit if you have very high drug costs, because once you hit that cap, you pay nothing for covered medications for the rest of the year.
But for most seniors with moderate prescription needs, the cap is irrelevant. What hits them is the deductible at the start of the year, every year, quietly rising. Here is what you do. Before October 15th, when Medicare open enrollment begins, go to medicare.gov and use the Plan Finder tool. Put in every single drug you take. Compare what different Part D plans would charge you in total for the year, including premiums, deductibles, and co-pays.
Many seniors are on plans they enrolled in years ago and have never reviewed. The right plan for your specific drug list can save you several $100s a year. Open enrollment runs from October 15th to December 7th, and any change you make takes effect January 1st. Do not let that window pass without checking. The third thing you need to understand is ARMA, and this one catches people completely off guard. ARMA stands for Income-Related Monthly Adjustment Amount.
It is a surcharge on top of your standard Part B premium that applies if your income exceeds certain thresholds. For 2027, the projected threshold starts at around $112,000 for a single filer and $224,000 for a married couple filing jointly. If your income from 2 years ago, meaning your 2025 tax return, put you above those numbers, you will pay significantly more for Part B in 2027 than the standard $209.50.
The first ARMA tier adds roughly $70 or more per month on top of the standard premium. Higher tiers go much further, and this is where the cliff problem becomes dangerous. ARMA does not work like a tax bracket where only the income above the threshold gets taxed at a higher rate. It works as a cliff. $1 over the line and your entire premium jumps to the higher tier for the whole year. A couple where one spouse sold an investment property in 2025 or took a large IRA distribution or received a lump sum pension payout could easily find themselves in an ARMA bracket they were not expecting. They will not find out until they get a notice from Social Security, often in late 2026, telling them their 2027 Medicare premium is higher than the standard amount. What most people do not know is that you can appeal an IRMA determination if your income has dropped significantly since that 2-year look-back period. The form is SSA 44. You can find it at ssa.gov or request it by calling 1-800-772-TOMSO13. If you retired in 2025 or 2026, if you stopped working, if your spouse passed away, if you lost a source of income for any qualifying reason, you may be able to ask Social Security to use a more recent income estimate rather than the 2025 figure. This appeal is not automatic. Nobody from Social Security is going to call you and suggest it. You have to know it exists and file it yourself. If your income has dropped since 2025 and you receive an IRMAA notice for 2027, filing SSA 44 immediately is one of the first things you do. The fourth thing you need to understand is the Medicare savings programs, and this is the one that Dorothy's neighbor walked her through at that kitchen table. Medicare savings programs are run by the state of Florida and funded jointly by the state and federal government. They exist specifically to help lower-income Medicare beneficiaries pay their premiums, deductibles, and co-pays. Most people have never heard of them. The Social Security Administration does not mail out brochures about them. Your Medicare plan's customer service line will not bring them up unless you ask directly. There are 3 main programs to know about. The first is QMB, which stands for Qualified Medicare Beneficiary. If your monthly income is at or below approximately $1,350 as a single person, the QMB program will cover your Part B premium, your Part A premium if you have one, your deductibles, and your co-pays. All of it. For a single senior living on Social Security alone, like Dorothy, QMB eligibility is worth checking immediately. The second program is SLMB, the Specified Low-Income Medicare Beneficiary Program. The income limit for this one is higher, around $1,620 a month for a single person, and it covers the Part B premium. Not the deductibles and co-pays, but the premium itself. For someone right at the edge of the QMB limit, SLMB can still save over $200 a month. The third is QI, the Qualifying Individual Program, which extends partial premium help to slightly higher income levels, up to around $1,120 a month for a single person. The income figures can vary slightly year to year, so always confirm with your local SHIP office when applying. Here is what you do. Call your local SHIP office. SHIP stands for State Health Insurance Assistance Program, and it is a free counseling service available to every Medicare beneficiary in Florida. These counselors are trained specifically to screen you for Medicare savings programs and other assistance. To find your local SHIP office, call 1-800-963-5337 or visit shiphelp.org. This service costs you nothing. You do not have to be extremely low income to call, you just have to ask. Dorothy called her local SHIP office after that conversation at her kitchen table. She qualified for SLMB that covered her entire Part B premium. The raise that Medicare was about to take back stayed in her account. The fifth thing you need to understand is extra help for prescription drug costs, which is separate from Medicare savings programs and routinely overlooked. Extra Help is a federal program administered by Social Security that reduces your out-of-pocket costs for prescription drugs. If you qualify, your Part D co-pays drop to a maximum of $3.90 for generic drugs and $9.85 for brand-name drugs, regardless of what your plan normally charges. The income limit for Extra Help is approximately $23,740 per year for a single person, or about $1,795 a month. Asset limits also apply, but they are more generous than people expect, and some assets like your home and one vehicle do not count at all. If you are in or near that income range and you are paying more than $10 or $15 for any of your prescriptions, you owe it to yourself to apply. The application is available at ss8.gov or by calling 1-800-772-1213. You can also apply in person at your local Social Security office. Extra Help is renewed automatically each year for people who qualify through Medicaid or a Medicare savings program, but millions of seniors who would qualify based on income have simply never applied. They are paying full deductibles and standard co-pays year after year when they do not have to. The sixth thing you need to understand is the interaction between the COLA, your taxable income, and Social Security taxation. This is the piece that surprises even relatively informed retirees. Up to 85% of your Social Security benefit is taxable at the federal level if your combined income, which includes your adjusted gross income plus half of your Social Security benefit, exceeds $34,000 for a single filer or $44,000 for a married couple filing jointly. Here is why the COLA makes this worse. Every time your Social Security benefit increases through a COLA, your gross benefit goes up. Half of that larger benefit gets added to your combined income calculation. If you are already near those thresholds, even a modest COLA increase can push more of your benefit into taxable territory. You do not just get taxed on the new amount, you can end up with more of your existing benefit becoming subject to tax. The thresholds that determine how much of your Social Security is taxable have not been adjusted for inflation since 1984. They are frozen. The COLA moves your income up every year. The threshold sits still. Over time, more and more retirees cross into higher taxation of their benefits simply because of the annual adjustment mechanism that was supposed to protect them from inflation. Florida has no state income tax, which does provide real relief. But the federal tax on Social Security benefits applies regardless of what state you live in. Here is what you do. If you are not sure whether any portion of your Social Security is being taxed, look at line 6B of your most recent federal tax return. That is the taxable amount. If it is greater than zero, you are already in the taxable range. If you want to understand how your 2027 COLA increase might affect your tax picture, a free visit to a SHIP counselor or a one-time consultation with a tax professional before year-end is worth considering. You are not looking for complex strategies, you are looking for awareness. Knowing where you stand is the first step. Now let us come back to Dorothy for a moment. She sat at that kitchen table not knowing any of this existed. She thought the COLA was a raise. She thought Medicare was a fixed cost. She had no idea that SHIP was available for free, that SLMB would cover her Part B premium, that extra help could reduce her drug costs, or that the taxes on her benefit were being recalculated upward every single year, even though the thresholds had not moved since the Reagan administration. She was not uninformed because she was careless. She was uninformed because none of these programs come with a notification. No letter arrives from the state of Florida saying you may qualify for a program that will cover your Medicare premium. No letter arrives from Social Security telling you to check whether your drug costs qualify for extra help. The system is not designed to find you. You have to find it. And that is exactly what Dorothy did. And what she discovered changed her monthly budget in a way that a COLA never could. Here is what matters coming out of this video. First, the 2027 COLA projections are showing an increase of somewhere around 3.7 to 3.8%, which translates to roughly $70 to $80 more a month for the average retiree. The official announcement comes from the Social Security Administration in mid-October. When it does, calculate your actual net increase after the Part B premium deduction. Do not celebrate the headline percentage without running those numbers. Second, the Part B premium is projected to rise to $250 in 2027, and the Part D deductible is confirmed to increase to $700. Use the Medicare open enrollment window, October 15th through December 7th, to review your Part D plan at medicare.gov and make sure you are on the right plan for your drug costs. Third, if you received an ARMA notice or expect one based on your 2025 income, and your income has dropped since then, file Form SSA 44 at ssa.gov or call 1-800-772-1213 and ask for help with an IRMA appeal. Fourth, call your SHIP office at 1-800-963-5337 or visit shiphelp.org and ask to be screened for Medicare savings programs and extra help. This call is free. It takes less than an hour. It can be worth several $100s a month depending on your income and situation. Fifth, if any portion of your Social Security is currently being taxed at the federal level, a COLA increase may push more of your benefit into taxable territory. Knowing that now gives you time to plan before January. Acting before the end of the year matters because the enrollment windows are real. October 15th through December 7th for Part D review. The SHIP screening can happen anytime, but getting it done before the new benefit year begins means any program you qualify for can be in place from January 1st. Waiting until March means you have already paid 3 months of a premium you might not have needed to pay. This is not legal or financial advice. Always verify your eligibility, benefit amounts, and program details directly with Social Security, Medicare, or a qualified advisor before making decisions. If this helped you understand what is about to happen to your 2027 benefits, share this video with one person you love who is over 65. One conversation, one phone call to a SHIP office can put hundreds of dollars back in someone's pocket. That is what this channel is here for. We work for you, not the system.